same basis issues basically exist for S corporations that existed for partnerships. And that is to say, shareholders in S corps have to compute their basis amounts just like partners do in their partnership interest. And there's also an initial basis scenario that is very similar to that of partnerships, although it goes back to the corporate rules. Um, uh, from way back when we talked about corporations and how you handle shareholders contributing assets to form a corporation. So, but we've covered some of this stuff before. So look through how to calculate initial basis. Annual basis adjustments exist the same as they did for partnerships. So we're adjusting our basis for income, up for income, down for losses, up for contributions to the S corp, down for distributions from the S corp, so on and so forth. So you can look through some of those key facts right here that tell you about how basis gets adjusted up or down. Good example right there. Loss limitations. This is getting at the same thing we talked about for partnerships. What do S corporation shareholders get to deduct on their personal return when the S corporation flows losses to them? And again, there's a tax basis hurdle. There's also at risk and a passive activity hurdle. The same hurdles exist here that existed there. The main difference with tax basis limitation for S corps is that you remember for partnerships, partnership debt was part of the basis number of the partners, but for S corporations, S corporation debt is not part of basis for the S corporation shareholders. So instead, we just have the typical, we call it stock basis calculation, where we do the initial analysis and then annual adjustments up and down. You have all that like normal, but then you can also create debt basis in an S corporation if the S corporation shareholder loans money directly to the S corporation. That gives them a second class of basis called debt basis. And both kinds of basis can be used to deduct flow through losses on individual tax returns. And you can see through these next couple of examples how this works. Here, in this example, her opening basis was $14,000. They report ordinary loss. How much loss is allocated to Nicole? Well, she owns a third, so $20,000. But how much of that loss could be deducted on her tax return? So the amount is only $14,000 because that's her basis. So she'd reduce her base. She'd deduct $14,000 on her personal tax return. That would reduce her basis down to $6,000. No. Her basis would go down to zero, and then she would have an extra $6,000 of what we call suspended loss carryovers that she'd be able to use in the next year. This next section talks about debt basis, where an S corporation shareholder can loan money directly to an S corporation, and then this example gets at what happens if you have two different kinds of basis, how is it used in deducting losses, and how is that basis restored when income finally flows through from the S corporation in the following year. And that's really all we're going to do to finish up this chapter. We're not going to talk about the rest of the learning objectives.